Concerns of a potential recession in U.S. economy are emerging, fueled by commentary from Atlanta Fed on U.S. growth, drop in consumer confidence, and statements from U.S. President Trump. This uncertainty has triggered a reaction in the markets. U.S. equity markets indices are down approx 4 to 8% in the last 2 weeks, while yields have softened by 50 bps from the highs, and dollar index down by approx 5%. After a series of flip-flops, trade tariffs have now become a reality, with more such measures slated to be implemented in the near future, impacting major trading partnerships. Looking back, a historical analysis suggests that previous tariffs, such as those imposed in 2018, did not deliver the anticipated benefits to the U.S. economy in terms of job creation or boosting manufacturing. Current tariffs, if continued for a year, are likely to result in U.S. inflation rising by approx 1%. Aiming to revitalize its economy, China has implemented major measures designed to stimulate both the overall economy and its stock market. Turning to India, recently released GDP shows uptick in economy. The third quarter GDP grew by 6.2%, higher than the previous quarter's 5.6%. The rise has been driven by increases in private consumption, government spending, and exports. Government capex, which had slowed down, has now rebounded to approximately 1 lakh crore per month. Furthermore, income tax cuts, coupled with subsidies or incentives offered by state governments, are also expected to provide a boost to consumption. Quarterly earnings results for Indian corporates have remained in the single digits for the past 3 quarters. However, results were in line with muted expectations. If we look at possible reasons which might have caused market corrections, most of these concerns have moderated or have seemed to be factored in by the markets. Bond yields have fallen by 40 bps. The dollar index has also corrected. Tariffs are now in effect, although their full impact is yet to be realized. Government capex has recovered. The Reserve Bank of India has eased liquidity conditions. Valuations have moderated from the peak levels. Almost 50% of sectors are now trading at a discount relative to their 10-year average price-to-earnings (PE) ratio. This data suggests that the recent correction has created pockets of potential investment opportunities. While earnings per share growth for the fiscal year 2025 is projected to be modest, at just 4.1%, expectations for the following years remain positive. Specifically, we anticipate 1,200 for fiscal year 2026 and 1,370 for fiscal year 2027. Temperature gauge index remains in the fair value zone. Equity markets remained in the correction zone during the last 1 month, with selling witnessed across the market segments. Amid the continuation of uncertainty due to various factors like imposition of tariffs by U.S., concerns over possible U.S. recession led to fall in dollar index and 10-year yields. India Q3 GDP numbers, along with announcements by Government of India to boost consumption and by RBI to address liquidity concerns, indicate economic momentum to pick up. Corporate earnings are also likely to improve and show decent growth over the next 2 years. Recent corrections have made valuation of large caps, Nifty 50, to fall below the 10-year average on 1-year forward basis, while mid and small cap indices still trading at premium, with pockets of opportunities seem to have emerged. In such a scenario, with signs of economic recovery and improved margin of safety in terms of valuation, risk rewards look favorable from long-term perspective. Considering the recent corrections, if equity allocation is lower than desired levels, investors can increase allocation by implementing a lump sum investment strategy for hybrid, large cap and flexi cap funds, and staggered approach over the next 3 months for mid and small cap strategies, with accelerated deployment in the event of a meaningful correction. The Reserve Bank of India has continued its measures to ease liquidity conditions. RBI announced OMO purchases and US dollar to Indian rupee swap to address liquidity. RBI did 25% reduction in the risk weights assigned to bank loans provided to non-banking financial companies, NBFCs. This action is projected to release approximately 40,000 crore Indian rupees into the banking system. With the evolving interest rate scenario, in our view the duration play is in its last leg and long-term yields to remain higher for longer, and hence duration can be exited fully. Actions by RBI on rate cuts and liquidity are likely to result into steepening in yield curve. We recommend fixed income portfolio to be overweight on accrual strategies. Accrual can be played across the credit spectrum by allocating 45% to 55% of the portfolio to performing credit and private credit strategies. In VEETs and select NCDs, 30% to 35% may be invested in performing credit strategies, NCDs, and in VEETs. 20% to 25% may be invested in private credit including real estate, infrastructure strategies, and select NCDs. 25% to 35% of the portfolio may be invested in arbitrage funds, minimum 3 months holding period, floating rate funds, 9 to 12 months holding period, and absolute return long-short strategies, minimum 12 to 15 months holding period. For tax-efficient fixed income alternative solutions, 20% to 25% of the portfolio may be allocated in conservative equity savings funds, minimum 3 years holding period. Considering 10-year rolling period over last 40 years, gold has outperformed the Sensex in only 36% of the cases. Investment in gold should primarily be considered from an asset allocation perspective.